Somber. Hello, ladies and gentlemen.
Thank you for
Here's
inviting me,
Dr. Milan Somberg and another guest on our financial show. And also, he's technically responsible for this recording is Jim Eid from Eid Foundation. Welcome to the show, Jim.
Hi, Sasha. Sorry about that. I made a mistake, and so I
Oh,
caused you to stumble at the beginning. Sorry about that.
that's okay. We'll go through it all.
Yeah.
And there could be other guests showing on the show. We'll see how it goes. So, today is something happening. It's Wednesday and the market is down. Oh my God. There are only two reasons for that. Number one, it's not typical Wednesday. It's actually a Tuesday because on Monday market was closed.
yeah,
So today is not typical Wednesday. It's
that
rather
explains. That explains.
That's
extended
it.
extended Tuesday. That's okay. And another thing is that there is a vote in the House tonight. So market is hesitating to do anything significant because of this vote. We all know result of the vote for sure, but the vote has to go, has to happen. And it's not just numbers, it's also how it will proceed, what kind of bedlam will be there, and what will be kind of songs and dances and so on. Well, we'll see it later on tonight. So, in a way, let's talk about now how do I personally mitigate this situation? All my positions are heavily hedged, and this time as heavy as ever before. You'll be laugh at me, but preservation of capital is number one rule, right? So, for example, Nvidia generated incredible profits for me lately, and even now I'm still sitting on some profit. But you always, first of all, at the end of last week, I almost went into cash. I had only 15% in stocks and 85% in cash on my fund portfolio, of course. Now, with NVIDIA, I scaled it down to only 100 shares. Not only that, I sold, believe it or not, 390 July call against 100 shares. So it's only one call. But that call generated 2430. It's give or take $2,400. So this is my protection for possible downward in NVIDIA, which is happening today, and it started tomorrow. Yesterday, sorry, and it continues today. But I'm heavily protected on this position, and there are just too many people are waiting NVIDIA to slide to say 350, 360 a share to get into the stock. We'll see if it happens. It could happen, but I think that the downside is rather at 375, and from that point on, it will resume its movement. Some other positions also all scaled down, all heavily protected. For example, tomorrow, Lululemon is reporting. You remember story about Lululemon from
Yeah.
last reporting? Okay, I have, again, very small positions, only 100 shares. And, of course, I sold June 2nd, 332 and a half call. The stock is now at 332, so it's almost at the money. It generated to me, for me, $1,335. That's kind of protection I'm talking about. Now, what's happening is if the stock reports tomorrow, and it will be spectacular earnings, the stock will obviously will go higher, and I will still make a very substantial profit because stock is going, when it's going higher, it's going much faster and more significant distance than the underlying covered call. So this is what type of protection I have in mind. So I don't care about today's mishap, and it's good chances that tomorrow Um, it could be tomorrow will be different market. Depends on how things happen tonight at this house meeting, right? Now, is Shakil going to join us now?
I think he's having technical difficulty. Couldn't start his
I
video.
see. Okay. So let's recap of what we discussed last week. And let's start with the, for example, we discussed actually several very important issues. One, Milan, you sent me a list of what we'd like to discuss today. Let's do this. So let's ask you, what's the issue number one that you would like to discuss?
Milan?
Oh,
Milan?
yeah. Well, uh, I mentioned recently that I did not have a fund portfolio because the business of holding the S&P 500 over the long term will outperform. But it was boring. It was like watching grass grow, watching paint dry, like Paul Samuelson said. So I needed to do something exciting. So I got a small position in Coca-Cola for a couple of reasons. First of all, Sasha, you mentioned you had two small positions. Small positions are meaningless. If you have a small enough position, doesn't matter what it has overall, it will not do a lot to your portfolio. However, in a fund portfolio, you can do that. So out of boredom, I got some Coca-Cola for a number of reasons. One is a lot of people follow what we do at Monday Morning Millionaire. And so the entry level people would find it difficult to get a board lot of SPY, for example, which tracks the S&P 500 accurately and bang on. So it would cost them over $40,000. But if they got a board lot of Coca-Cola, it would cost them $6,000. So then they can initiate selling covered calls. And when it's called away from them, they can sell cash covered puts, just in the money cash covered puts. And that produces wonderful results overall. So I bought Coca-Cola partly for the fact that it requires a small amount of money to get into, and partly because that it is one of the major holdings of Berkshire Hathaway. Warren Buffett has a large Coca-Cola position and has had it for years and years. And he says that Coca-Cola has a large moat, meaning that very few other companies can compete with it. So that's my position now. In my fund portfolio, small position in Coca-Cola. Doesn't matter what it does, it will not do very much for my overall portfolio. So there you go.
So I don't get it. You just mentioned that the small position
Yeah.
cannot affect your overall position in any meaningful way. So it
Exactly.
doesn't matter. It moves one way or another way. So what's the point to initiate the small position?
Well, let me ask you, what's the point? Because you told us earlier today that you had two small positions in, I've forgotten what the securities were, but you mentioned the word small position a couple of times. So why take small positions, Sasha?
I will explain. Let's see. First of all, I'm talking about only fund portfolio. So overall, the small positions for fund portfolio, they may not be that small. If I had, for example, 600 shares of NVIDIA, is that a small position or what? Is that small position? I'm sorry, for some people, it's a life savings position.
Right, yes.
And if stock is moving from around 325 to 425 on 600 shares, I would challenge even some fund managers to call it small position. And I think a lot of them wish they would have that small position. I don't think that a lot of them
That's
get
true.
it.
That's true.
Okay. Here's talking about small position. Now, for example, I do have small position, 200 shares in a stock.
We got away from the noise.
Hello.
Hi, Shakil.
I'm talking about the stock CRM, which reports.
Maybe
Sorry about that.
That's okay. I'm talking about CRM, it's Salesforce, which reports later on after the market closed to get today. It's quite expensive stock. It's not Coca-Cola or something else. It's much more expensive and much more volatile stock for that matter. And I hedged this position too. However, stock is already moving higher, so my hedge, I'm not liquidating my hedge, still over there.
I need more light. Yeah.
Reporting, we'll see how it goes.
Sasha,
Yes.
instead of calling it an expensive stock, it might be correctly priced. Would it be more accurate to call it a high price stock?
Yes, agree with that. However, now let's talk about the concept of efficient markets. So I know, Milan, you are for this oxymoron, which is efficient market. Now, let me say Coca-Cola. When you bought stock Coca-Cola, you believed that it was efficiently priced by the market, right? So if it's efficiently priced and all available information is already priced into the price of the stock.
That's the idea
So,
of efficient market. Yes.
okay, efficient market theory. So what is the point of buying stock where all known information is already into the price of the stock? What will make the stock going higher or lower or stay the same? Everything is already figured
The
out
point,
in the price.
yeah, the point is that it then serves as an underlying security for selling covered calls. When it's called away, uh, just out of the money, you should sell covered call just out of the money. When it's called away from you, you are in cash. Then it allows you to sell just in the money cash cover puts. So you have to own the security to sell covered calls. So that's why Coca-Cola. If everything is known about it, that's right. Then it's correctly priced. That's right, unless you have inside information, which is criminal, illegal, and
No, only in some countries. It's perfectly legal in New Zealand for some
Yes,
bizarre
let's
reason.
welcome Shaquille. He's down under, so his screen is a little dark, but
Yeah, so I do apologise, and actually, Jim, you'll be pleased to know I'm actually in Africa
Oh,
at the moment. So sorry about the bad connection, the bad lighting. I've jumped in the car because it was a little bit
it will
noisier
be dark in
where I
Africa
was.
as well.
a
Yeah.
world traveler,
um,
Shaquille.
so just for our audience, often many people know that I either do or have run financial institutions like hedge funds, that sort of thing. But everything that I say, you should take as just information or entertainment value. Don't act on anything that I say without seeking your own professional advice from a suitably licensed professional in that field. I just want to address a couple of things with efficient market theory. So I'm not a proponent of that personally. I don't think that's true, um, because I don't actually think the world is particularly efficient. I don't think that, we talk about different economic theories. We talk about different systems of governance. We talk about all sorts of different things. And clearly things are not ever going to be as efficient as they could be. So the idea that all information that is known is immediately reflected in the price of securities at any given time, to me just doesn't make a lot of sense. Jim and I were on a show a few years ago, and there was the IPO. I think you were on the show too, Sasha. There was an IPO for Snowflake or Snow something,
Yes, I remember.
and I on air live bought. I can't remember. It was a reasonable position, and I sold it, a few minutes later, and made a pretty reasonable profit. I can't remember how much it was. Jim, do you remember? It was 10 grand or 100 grand
Yeah,
or
it
something. I
was
can't
Yeah,
remember.
yeah,
something
something
that
like
was.
that.
It was something pretty big. Now, what are we suggesting? That the price when I bought it was efficient, and the price that I sold it a few minutes later was also efficient? I can't see that being true. When we then go across to to options trading, it's a really interesting proposition, because by rights, if you buy options at the money and you believe in efficient market theory, you should actually make about as much money as if you sold the options at the money, because there shouldn't be an arbitrage, right?
if
We
you buy
know that that's not true.
if
We
you
know
buy
that deltas change. We know that gammas change. We know that theta changes. So all these things are gonna have an effect.
Shaquille, if you buy options, you could lose 100% of your money. That happens, and often enough. Now, the amount of money you lose is never a great deal. People understand that, but they should be prepared to lose it all if they buy options. Now, we recommend only selling covered calls and cash secured puts. That way, you always make money. Now, the
So,
efficient
so Mr.
theory,
Milan, sorry, go on. I don't mean to cut you in. Sorry, there's a bit of a delay on my internet.
the efficient market theory is generally accepted by the academic community, but there are some exceptions, particularly arising from the psychology involved in the stock market. So, what was the name of that psychologist who won the Nobel Prize for economics? Even though he was a psychologist, he was not an economist. His name escapes me for the moment. It'll come to me later.
Yes.
But so the efficient market theory is modified by the psychology of investing.
Well, that's exactly right. What we saw with NVIDIA popping was all of it is AI news, and all of a sudden the crowd got into a frenzy and bought the stock. And now they're calming down a little bit, and the stock is coming back down. Now it's a good stock in the long run, and Sasha and I have been talking about it for a long time. But that pop, that surge, which was unexpected for me, was due to psychology.
Not only that, Jim, it's also due to a squeeze of a short sellers.
Yes.
That. Because NVIDIA reported and went up for another day or two. So according to the normal market behavior, it had to sell off because there are too many people sitting on too much profit. It should sell off, going back to 360, maybe level 370, whatever, and then probably make a little base and then start to go up. No, it continued to make up another 10%, and that 10% was a short squeeze, a classical one. There are a lot of short sellers, they are waiting for a correction and so on, and the market goes higher and higher, and they have to cover, and that created that effect, obviously. There is nothing wrong with the company or with the stock. It's a typical.
Oh no, and that's why the information theory is solid in many cases, but in the case of that we're talking about in NVIDIA, for example, it's not a good judge for specific cases, and so there's no way that everybody was acting based on the total amount of information. And there's also the factor, and this is psychological as well, is that I think if you have the same information I have, I'll profit from it better than you will, because I know what to do with the information. My decision making will be better than yours. And that's what a lot of investors believe. I certainly believe it. Shaquille, you believe it.
Sorry, I dropped out there for a minute, so I did miss a little bit. I just want to just address a couple of things. So, Milan, look, my great nemesis is the covered call. I've always disliked that strategy. However, I work in the industry, so obviously I'm going to look for things that are, in my view, more efficient. It's not a bad strategy, and especially for retail investors, for people that are just trying to enhance their portfolio returns. For older people as well, that they've got a bunch of shares sitting in their retirement accounts. Not a bad way of going, not at all. But I think that shows a big difference between how, if we believe in market, in efficient market theory or in CAPM theory, then there shouldn't be any distinction between a professional investor and a retail investor, and there also shouldn't be any distinction between Jim and myself when it comes to buying and selling shares. But you know what? If Jim rings me up and says, "Hey, Shaq, there's this IT company that's going to have an IPO next week, and I really feel confident about it," that is going to, even though I'm a professional at this, that's going to sway my view a little bit, because he's from California, or he lives in California. He's a little bit more in the know over there. It's like playing chess, right? We could all look at the same chess position, and because I'm nowhere near as good at chess as Jim and Sasha is, they're going to look at the same position as me, and I might, come up with some great move. I'm going to go sacrifice my queen, and Sasha's going to hit me over the head and say, "Why are you sacrificing your queen?" Right? But that's just because all of us are different, and we view things differently, and we prioritize information differently. So we know with behavioral science, behavioral finance, we know that you might look at at a company like Home Depot, which I have significant shares in at the moment, has dropped in price today. Now, I think personally that Home Depot is a little undervalued. That's why I've got the shares. But you know what? I bought them and they kept falling. And I've had this position for longer than I wanted to. Now, I think, and obviously I think that they're going to go up over time. That's why I hold the position. But when I see a bad report, like it's their sales has been a bit soft, I'm not putting quite as much emphasis on that. I'm putting emphasis on something else. Whereas somebody else who's just as qualified as me might put more emphasis on that and think it's worth selling. So that's why I really don't think that efficient market theory holds true. And you can't prove that, right? It's just a matter of personal opinion. But for me, I don't believe in it.
I mentioned earlier that the name would come to me, and it's Daniel Kahneman. Daniel Kahneman, psychologist, won a Nobel Prize in economics for the role of psychology, for his description of the role of psychology in investing, which modifies the efficient market theory significantly. There are 3 levels of efficient market theory, and it's pretty detailed stuff. You can certainly look it up on the internet. But yeah, it is modified by the way investors feel about an investment.
And all that, may I ask you, Milan, how does that enhanced efficient market theory help people make money?
Well, as I mentioned earlier, you need to have an underlying security on which to write covered calls. Writing covered calls makes money.
But I've asked you about the efficient market theory. How is that enhanced theory? This element of psychology.
Okay, let's say that the efficient market theory holds all the time. It doesn't. The psychology of it plays a role, significant role. But let's say that it holds true all the time. Then you, at the correctly priced level, purchase a security which all other people know about and are willing to pay exactly the same price, but you purchase it to give you an underlying security on which you can write covered calls, which makes money all the time, except in rising market. In steeply rising markets, you're much better off holding the market itself than holding a covered call on it.
So basically, your concept is to try to find underlying security using as a cover to sell covered calls. What efficient market theory has to do with that? Especially, it doesn't hold anything. If you take any stock, Coca-Cola or Nvidia is now, say, 385, and then 2 minutes later it's 386. So what is the right price for Nvidia?
It's irrelevant. No, it's irrelevant. All the risk of derivatives, writing covered calls, selling, buying, all the risk of the derivatives comes from the underlying security. The act of writing covered calls and cash secure puts is totally risk-free, but the underlying security.
Oh, Milan, sorry, I have to come in here. That's a misunderstanding of options trading, and I think it's very dangerous. Because just a couple of things. Firstly, the price of the options themselves are subject to volatility, the Vega calculation, that volatility price can actually move without there being any change in the price of the underlying. The second thing is that we know that deltas and gammas are going to move sometimes without or move disproportionately to the move that's occurred in the underlying. But the most important thing for people to remember is to say that these always make money. You have actually limited your upside potential profit, and you have got the same or approximately the same, less the premium, the same downside risk. So if you buy the shares at $100 a share and they drop, you're going to lose $100 less the premium. But if the thing goes up, you're restricted in your profits to the premium and the difference between the strike and your purchase price, and that skews your risk reward quite substantially.
I need to provide a little more detail, and the detail consists of the following: you sell your covered call or your cash secure puts on a Monday, expiry date Friday of the same week. That will be the right thing to do half the time. But as you approach the expiry date, the put or the call keeps losing its value and totally disappears, which means you get to keep the cash entirely. So that's the thing that I didn't mention, that it has to be the expiry date needs to be a week away from or close to the day that you initiate the transaction.
Milan,
Would you have wanted to be short call options in February and March of 2020? Would you have wanted to be short call options over the general market in those months, the weekly calls? I would say the same thing. You would have been subject to all of the losses, and you've capped your upside potential.
Okay, the value of a covered call or a cash secure put depends to a great extent on the volatility involved. The more volatile it is, the more you're going to get for selling, only sell, never buy, the cash covered put or the covered call. And so that period that you mentioned was the worst in stock market history, the very worst in stock market history. And yet people who followed this advice, that is on a Monday, they sold covered call, and it was called away from them. They would sell a cash secured put on a Monday, expiry date on a Friday. They lost much, much, much less than the market lost. And I have a PowerPoint presentation, which is almost an hour long, which shows that exactly to be the case.
So Milan, let me just say, I personally made more money during 2020 and mostly during 2020 than I've made in the rest of my life combined. I had an absolutely fantastic time during those market conditions.
Were you selling?
But I think it's really important to no, I don't short options. I normally buy them because I like to buy Vega. But I just want to point out that everything that you do is a trade-off, and there is always risk involved. I think it's a little bit dangerous to suggest that there's no risk involved, that you're always going to make money. But more importantly, I just want to point out that when you're seeing certain market conditions, things can work really well. But ultimately, you talked about the behavioral scientist or the behavioral psychologist or whatever that apply these things to academics. I don't want to be negative towards academics, but the only PhD I've got is from the School of Hard Knocks. And whilst I do have financial qualifications, I can tell you that when 2 Nobel Prize winners went and set up that great hedge fund that we all know, long-term capital management, not only did they blow that up, they almost blew up the world's economy. And those guys are the ones that wrote the options pricing mechanism. So
that's the fifth law of thermodynamics. When there's always an equal and opposite PhD. Right. For every PhD.
Well, and the problem is, if you actually look at LTCM's trades, they were right. They were actually right. Had they had enough capital to just hold for a little longer, they would have been right.
Let me ask you a question. And this is something that we talk about quite frequently because Sasha has his style and Milan has his style, and I think they're both right in that they follow their rule-based systems.
Yeah.
Methodically, and I don't mean that as a slam. I mean they're just disciplined, and I think as long as you're disciplined with what you're doing, you're going to have a reasonable chance of being successful. What I discourage people from doing is flip-flopping from one investment style to another. And if you're going to be a buyer, buy. If you're going to be a seller, sell. But stick to the rules. Like Sasha mentioned that if a stock goes down -7, there's a philosophy that you should sell at that point. And it's the rule.
Yeah.
And so if you follow those types of rules, I think that you're going to be disciplined. And as long as you're disciplined, you're going to have a reasonable chance to be successful.
Jim, thank you for a compliment, but it's not my system at all.
Yes, I know.
This is great William O'Neill, who just passed away at the age of 90, just a couple of days ago. He was an unprecedentedly successful investor, the founder of Investors Business Daily, which was the Bible of investment until internet came and there are now so many advisories.
Had to have it.
And by the way, Investor Business Daily is still something that I read almost every day. Now, what I'd like to mention is that he, who was deeply analyzed, interviewed in the Market Wizards. He's one of very few people who did their fortunes through stocks, because most of them were in commodities and futures and so on. So William Manila was one of maybe two or three who did their fortune and their style developed through stocks. Now, two rules that he published when I started to read the Investors Business Daily, I don't know, probably 35 years ago when it just came out. There are a lot of rules, but I'll mention two practical rules which I'm always following. Number one, if the stock, let's forget about options and covered calls and everything. Just let's say you have a naked position in a stock, and that stock lost 7%. Sell it. No questions asked. No, you're thinking about all this wonderful company. It will recover. It will just start it. So there's just so much. Just okay, it will lose another maybe 1%. Then it will start to have incredible run. No, you sell first, and then when incredible run will start, you will buy it back. Maybe $1 more than it was when you sold. It doesn't matter, but you already see that there is rising, because normally stock, before it will keep rising, it has to stop dropping. If stock is dropping,
Sasha,
forget about
Well,
rising. There's
well,
no such thing.
well, Enron and WorldCom certainly never stopped dropping, and I believe you can still get shares in them on the pink slips. But let me just say, let me just say a couple of things real quick. If covered calls are such a good strategy, why not do bull put or bull call spreads? Because you've got less risk. If the answer to that is because if the stock drops a little bit, then you've still got the underlying. Then why don't you buy a longer term call and sell short term calls against that? I mean, that would give you the same effective result with less risk, and you'd get a higher rate of return on your money. So that's a more efficient way of doing it. But secondly, what I wanted to say is, if you compare the S&P 500 buy right index and you have a look at its returns over that 2020 to 2022 period, that dramatically underperformed the markets. However, had you have done that, bought the S&P 500 buy right index and short sold the S&P 500 for the previous decade, you actually overperformed the markets. And so, specific market conditions are going to play a really big effect, and we don't have a crystal ball. We could be really certain that we're going to increase interest rates, but we don't know. They could drop them next week. We don't know what's going to happen.
Shakil, I agree with you, but what I mentioned is that the 7% rule, it's part of your discipline as an investor.
Yeah.
You cannot guess whether it will drop only 7% or 9% or 15%. You don't know that. So you always limit your losses. It's the same thing when you're playing in a casino, blackjack. Okay, you start with a bankroll, say $10,000. You lost 1,000, which is 10% of your bankroll. Out. You have to move away from the table. Go to another
Sasha,
table.
Sasha, haven't you seen that meme that 99% of losing punters would have hit it big if they just stayed that one bet longer? But look, let me just say this sort of contradicts though the argument for covered calls and written puts, because people say to me, I'm going to sell a put because I want to buy the share at a discount. Well, you only buy the share at a discount if the stock drops. So I would say the same thing. Why not dollar cost average? Something that I would never suggest people do. But why not dollar cost average? If you really like the shares at $100 a share and it's now at $93 a share, buy some more because you thought it was a really good buy at 100.
This is exactly what I did with NVIDIA. It was like a pyramid. I started to buy NVIDIA around 325, over 300 for sure. 325, okay, I was trading NVIDIA back and forth, making money or so on. But at 325, I became sort of serious that stock could go to 500 and maybe more. So I started to build position. I bought at 325. It went to 350. I bought more at 350. So now my average price is 337 or something. Then I keep buying now more, even 200 shares and another 200 shares. I increased my position eventually to 600 shares. Naked, I didn't sell any covered calls, and only then after market report and stock was just going through the roof, then I started to adjust my position. Today I have only 100 shares. It's a little bit of a correction, probably the short selling recovering and so on. So, okay, we'll see. I don't worry about NVIDIA because I already made so much money that I don't care even if I will
Question for you,
lose
Sasha.
part of it.
Gentlemen, I'm sorry. I am going to have to. I am going to have to leave a little bit early. Thanks for having me
Thank you.
on, Milan. Great to meet you, James. Good to see you again, Sasha. Thanks for inviting me.
Thank you.
Hopefully, I'll catch you again when I've got some more time.
You're
Good
very
night.
welcome. Bye
Take
bye.
care of yourself.
Well, I'm sorry that Shaquille is leaving because, Sasha, I wanted to ask you, did you ever dream what your next market move should be? Because, in your Market Wizards book, there's an individual who wants to remain anonymous, and I understand why, is he dreamed what he should be doing in the market. He dreamed it. How can you take a person like that seriously?
He believes in his subconscious.
And I don't know. I have different dreams sometimes. Nothing to
I
do
don't
with
dream
art.
about stocks.
That has happened in music. Tartini's Devil's Trill Sonata is
Yes.
a standard repertoire material. The devil came to Tartini and said, in exchange for your soul, I will show you how to play this. And then he played Devil's Trill Sonata in Tartini's dream. Tartini woke up and wrote it all out. It's a fabulous piece of work. He dreamed it. But this guy dreamed what to do in
No,
his
this is
next
very strange concept about something to do with your soul. Because if you remember the Notre Dame de Paris book, show, and so on, in the show there is a song, there is an aria where Quasimodo, I think he's singing about that he would sell his soul for a night with Esmeralda. Okay, I understand the concept of spending night with Esmeralda, but who needs his soul? Who would buy it? That's what I always had difficulty.
There's a collector of souls out there.
Poor Quasimodo. Okay, listen, I'll tell you, it was very interesting to, as always, listen to Shakil's observation. However, I forgot about telling the William O'Neill's Rule 2. Rule 2 is very simple. If and when you have a margin call, don't ever bring new money. Sell your position or let the broker sell. Maybe, see, at the time before internet, you can hold on to your losing position on the margin call for 2-3 days. And some people who had a good-hearted broker could get even 5 days extension, and it doesn't work really well for you because you would already could lose even more money. But anyway, regardless what your broker does, his advice is you got margin call, sell it. And you know what? Sell it the moment you got margin call. Sell it at this moment. Don't play the situation may change. And actually, the market is recovering. Your stock is now started to recover. Don't believe that. Just sell out. So these two rules. He has more rules, of course. You can find it in this book. But these two rules are working in any market, anytime. Doesn't matter. The only thing is the 7% rule. I'm not following religiously simply because all my positions are hedged. So because options are involved. So now 7% rule, I would extend it to 10%, some cases even 15%. Because let's see, if I sold what I was talking before, let's take one of my positions and let's see, Lululemon. No, Lululemon is not. It's not really moving that hard. It's down about $4.50 for a day today. But I sold June 2nd, which is this Friday. Oh my God! I sold one call collecting $1,335. So that allows me, if Lulu will drop another, 5% or so, I'm still in the money. I'm still not losing. So I really don't care really what's happening. It's my similar position as others. I'm selling deep into the money calls. Deep. So I allow stock to drop 10% on me in a matter of 2 days. That's fine because I'm not losing money anyway. And if the stock will reverse, maybe tomorrow market will go ballistic, there will be a great deal signed or so. That's fine because market when stock is moving higher,
And
You're
this gets back
losing on options, but still your result is positive.
this gets back into the psychology because we know that a lot of the market negativity has been around the debt ceiling and the fact that the MAGA Republicans want to play disaster with and hold everyone hostage to their demands.
Exactly.
And that it looks like there's going to be a reasonable bipartisan compromise that's going to take effect, and the market should respond. And that's going to be a psychological response rather than a logical, a rational based response. And how high that goes, it's very difficult to predict, but you can kind of count on it, just as you could count on it going down when they weren't sure. Was it going to come out of the subcommittee with a stamp of approval? It did by 7-6. Ooh, could have been 6-7 against. So there was uncertainty, and nobody in the market likes uncertainty. And so once we get certainty, we're happier and we go green. Our screens show green instead of red.
The two parties generally agree. And so tonight in Congress, they're going to vote on that, and then the House of Representatives. Now, failure to agree would make the worst economic disaster in history seem like a tea party.
Catastrophic, absolutely. Yeah. So who would even threaten it? Trump, when he was president, said that no one in their right minds would threaten it. And now Trump as a candidate is threatening it. So, and all the people that support him are thinking, and they're playing, and already it's had its impact that it's harder to lend. People will buy our debt, but at a lower cost, or to them in a steeper price for us. So it's already done damage to the economy, and it's just irresponsible to play like this. You should have a normal budgeting process to work out your priorities, and not play with this debt ceiling. It's just like Trump once said, it's unconscionable.
There are only two countries in the world that have that ceiling. It's the United States and Denmark.
Yeah,
two
right.
countries in the whole world. Now, what's interesting is that in the times of Trump being president, 2017, 2018, 2019, 3 times the ceiling was raised.
Oh, yeah.
And the debt of the United States generated additional $6 or $7 trillion in times of Trump.
This is 25%. Our national debt went up 25% during his administration.
This is hypocrisy of what's today's.
Since the Second World War, the ceiling was raised over 100 times.
Yes.
Yeah.
And it's just business as usual, unless you're into this hostage taking mentality.
So now with the COVID calamity, now the war in Ukraine, and there are several reasons to raise debt ceiling and so on. And I think that the Republicans keeping all American people, and not only American, as hostages, it's very unfair game. It's dangerous game. And of course, I understand that they want to hurt Biden as much as possible.
Yeah.
So someone, but Trump or DeSantis or whoever, will win the general election. I understand that, but the consequences could be very unpredictable, maybe even astronomically horrific for the United States. And I don't think that
this is why it was also politically short-sighted, because when you look at the agreement that they're going to come down to, it's a total victory for Biden. And the Republicans did not get their wish list, not at all. And what they're going to do is have 2 years, which will run out into the end of the Biden administration,
right, yeah,
where they're not going to have this discussion again. So they've given up all their leverage. And so Biden was masterful in this. And this may not be, he's not trumpeting it right now because they still haven't voted. But after they vote, people will be coming on the air and saying how stupid this Republican power play was, how it backfired on them.
What can we learn from the Danes, Sasha?
From what? From what?
The Danish people.
From Danish people?
Yeah.
I'm not following Danish politics. I've been there 4 or 5 times. I love this country. I love Copenhagen. But
I would love to visit. That's on my bucket list.
it's
Yeah.
a fantastic place. It's considered to be one of the best cities in the world, which
Uh-huh.
I totally agree. Well, the others are Stockholm, it's absolutely incredible city, and Oslo. I never been to Oslo, but these cities, of course, Rome, Paris, Amsterdam, just any
Oh, yeah.
city
Yeah.
is world class. So I
All of those.
I can't answer your question, Milan. Maybe you have some suggestions.
Well, we can study it. Talking about the best cities for livability, of the 10 best cities for livability on the planet, 4 are Canadian. Ottawa, Toronto, Vancouver, and I think Calgary. That says something about Canada, doesn't it?
Okay, agree.
Yeah.
Good
Are
for
there
you
any,
guys.
are there any American cities there, James?
I have always thought that San Francisco was, but it's not anymore. San Francisco has changed in the 20 years that I have been, well, longer, but in and around San Francisco for 40 years, and it's not the same city. But I always thought it was a beautiful city,
Yeah.
and it was relatively safe. No longer true, and this has happened to a lot of cities. I think. In the United States. San Diego, also in California, at the other end of the state, is also often mentioned as one of the more livable cities.
Yes,
And
agree.
at the top of the state, our state capital, Sacramento, is also mentioned
Mhm.
in some of these rating systems. But you have to be a certain type of person to live in New York City,
Yeah.
and
Yeah.
it's just not for everyone. Chicago is also the same thing, but all of our urban centers have been suffering from one is the mass exodus since the pandemic of work. So when we go downtown, the financial district in San Francisco now, it's unrecognizable to me.
Same thing in Toronto. The financial district with all those skyscrapers are more or less empty.
Yeah.
And they're looking for ways to convert them to housing.
Cheap housing, yes.
There's a huge shortage of affordable housing.
Right.
And these buildings are staying empty. You can see the traffic flow isn't what it used to be because
Right.
so many people are working from home.
Right.
And we'll continue to do that for a long time as long as they can be effective. And it's
Right.
possible. Yeah.
Milan, probably you haven't been in Toronto for a long time because traffic is horrendous. It's impossible to get from one place to another in less than an hour. Maybe.
The worst I experienced was in Boston.
Yeah.
I don't know.
Boston is horrible. I've been in Boston about 4 months ago or so. The traffic is horrific there.
Yeah.
It's probably even worse.
It's a lovely city. And so many, like you mentioned, New York, are
It's
great
wonderful.
places to visit, but not so great to live in.
Yes.
Yeah.
Well,
We-
I think I will let you say goodbye, Sasha, and we'll wrap up
Yes.
the show. So
Okay.
Milan, lovely to see you again, and I'm going to take you and me backstage and let Sasha wrap up.
Okay, and you'll send the links.
Yes.
YouTube. Okay, we had very interesting discussions today. Thank you to Jim, Dr. Somberg, and Shaquille. It's not Shaquille O'Neal. It's